Okay, so good good evening, everyone. Um, just kindly confirm, just one person confirm that you can see my screen and you can hear me so that we can start for today.
Yeah, we can see you, we can hear you. Good evening, sir.
Good evening. Okay, thank you very much. All right, so let's start our class for today. So today, what we have in front of us is a standard called IFRS 2. In the last three classes, what we have tried to do or achieve is for us to establish a background to what we have in front of us going forward. That was why in the first week, we started with regulatory framework. And in the second and third week, we explained critically conceptual framework. These two topics, as you are aware, constitutes at least 10% of your syllabus. They don't miss it every diet. At least you will see a 10 marks question from these two aspects you have learned. And the materials I've shared with you, there are a lot of questions there, a lot of past questions inside those two topics that I've sent to you. Please and please, you need to get used to those two topics. They are extremely important. They are not calculation courses, but they're extremely important. And you need to know something about corporate reporting. Corporate reporting is not all calculation. As a matter of fact, it's not really the calculation that would make you pass eventually. It's almost 60% all about principles, all about explanations, and maybe 40% calculation, right? So you need to understand that right from the beginning. So today is going to be our fourth class. And today, what we are learning is IFRS 2 on share-based payments. The first thing is this: why are we learning this topic? Or why are we learning this standard, share-based payments? And first, let's try and understand the background to this topic before I move into even why we are learning it. The background is that usually, when entities want to consummate transaction, when a buyer and a seller want to carry out a transaction, usually the seller will transfer goods or services to that buyer. Then in return, the buyer will pay money. And when the buyer is paying money, it's either the buyer is paying immediately or he can pay at a later date. But ultimately, the buyer is going to pay money. That is how transactions are normally. Whether you are a supplier, whether you are an employee, you work and they pay you money. But today, what we are looking at is that entities now have evolved. And what they want to do now, let's see entities as a buyer. What they want to do now is that anytime they receive goods or services, that buyer, instead of paying cash, whether now or later, now they want to pay with their equity instruments. They want to pay with their what? Equity instruments. So they want to replace payment of that cash for goods or services they have received. They want to replace it with the fact that they want to pay with their equity instrument. So the first thing here is this. I think you understand the fact that this is just a normal transaction. But the bone of contention here today now is that the buyer now wants to pay. That is, the consideration he wants to transfer in exchange for the good or services he has received is its equity instrument. So the first thing here is this: what is an equity instrument? What is an equity instrument? So an equity instrument is either shares, or share options. Is either shares of a company or a share option of a company. What's the difference between shares? If I issue shares or if I issue a share option, you see, when an entity issues shares, specifically, let's say ordinary shares, immediately, whoever is receiving those shares, if I issue shares to Fidelis, for example, now, immediately, Fidelis becomes my shareholder. Immediately, Fidelis becomes a shareholder of my company if I issue shares. So when shares are issued, whoever is the receiver of those shares become a shareholder immediately. But if it is a share option, if I give Fidelis share option, I said, okay, take a share option in my company. Fidelis does not become a shareholder in my company immediately. It doesn't become a shareholder. But what that share option represents, it represents like a promise I'm making to Fidelis. It represents an obligation on me. It represents a right of Fidelis to buy my shares in the future at a specific price. At a specific price. So what share option does is that it only gives the receiver of those options, gives them like a right to buy the shares of a company at a specific price at a specific future date. That's a share option. So don't let us let's narrow our mind down to this, that everything we are learning today is just a situation whereby an entity receives good and the consideration they want to pay for those goods they have received is their equity instrument. They want to give their equity instrument in exchange. So when we say equity instrument, I say it's either shares or share option. When they give shares, automatically the person becomes a shareholder of that company. But if they give share option, the person will become shareholder in the future. So the person must just hold on to that option till that date. We will see the differences between the two. Again, that's the background to this share-based payment. Again, why are we even learning this share-based payment? Why is it even a standard? Why are we even considering? What happened is this, around 2000, early 2000, when companies like Facebook, companies like, let's say Google, and companies like, let's say Amazon in the 90s and in early 2000, when all of these companies were coming up, all these technology companies, one of the ways they were attracting great talents was that they were giving them share options. They were giving them they were having agreements with their employees that if they can work with them for some number of years, they will become shareholders in their company in the future. So they were giving them share options. We discovered that these share options they were giving them, they were not accounting for it at all. They were not putting it in their books. There was this agreement that they will become shareholder in the future in return for their service, at least part of their service, but it's not anywhere in the books. So it only gets into the books when that day now comes up and the shares vests, or those people now convert to shares normally. That's the only time they will now increase their share capital. That was the practice then. So this standard said, no, that is wrong. That is wrong. That is not how it should be accounted for. So what we want to learn today is how it should be accounted for. And since the advent of this standard, we have seen a lot of countries that have now been allowing some tax benefits for companies that give this kind of employee benefits to their staff. That if they give their staff some of their, or like a share option, their tax authority in their country will allow it as a deduction from their expense, and it's always an allowable expense and they will not even tax it in the hand of that employee. So they are just trying to encourage a lot of companies to key into this type of transaction. Let's not forget, the core of this topic is the fact that entity receives good, and in return, they want to pay with their equity instruments. Now, we are going to be looking at 3 types of share-based payments in this class. And this will be the basis of everything we want to learn in this class. The first one is equity settled share-based payment. Equity settled share-based payment. And this type of share-based payment, the buyer, which I call the entity, they receive good, and in exchange for equity instrument of the entity. When I say equity instrument, I've explained to you that it means shares or share option. And I've told you shares, immediately the seller becomes a shareholder immediately when they give you shares. But when they give you a share option, you become a shareholder in the future. So that's the first type of share-based payment, equity settled share-based payment. The entity receives good, and in exchange, they give their equity instruments for those goods. So they are not giving cash, they give equity instruments. The second one is cash settled share-based payment. And this one, the entity receives goods, of course. So in exchange for an amount of cash. So in this case now, the company pay cash. However, these cash are based on the price of the entity's shares. So you see that eventually it's still attached to the shares of the entity. So under cash settled, the entity receives goods, yes, but what they are paying, what they want to pay now is cash. Like they will say, I will pay cash. But this cash will be based on my price in the future. So when we are still going to go deeply into each of these, but for now, what I want you to understand is that for cash settled, the entity will pay cash. However, the amount of cash is based on the price of the entity's shares. You will see it when we get it, but I mean, just understand that the cash is based on the price of the entity's shares. The third one, I call this one usually equity or cash. That's what I call this one. Why do I call it equity or cash? Because the entity receives goods, right? And it now gives the supplier or the seller, okay? He has a choice of either he wants to be settled in cash or in equity instruments. So what this means is that when the entity receives the good, so it's the seller that will choose, is the one that will choose eventually whether he wants to be settled in cash. When I say cash, in this context, always know that that cash should be based on the price of the entity's shares. It will be based on the price of the entity's shares. Okay, so let's come back here. So is the seller or the supplier that will determine whether he wants to receive his consideration in cash or in equity instrument of the entity. So he receives, so if I sell goods to Fidelis now, me, I'm the seller. So, and we have a share-based payment arrangement. Me, I'm the seller. So it's me that will decide that, okay, Fidelis, give me shares for these goods that I'm selling to you. Or I could tell Fidelis that give me cash, but we'll have an agreement that the cash will be based on my future price. My future will be based on Fidelis' future share price, right? That is this third option, right? We will get there. Hopefully, we'll look at that also. So those are the 3 types of share-based payments we are going to look at in this class. The equity settled, whereby the entity will settle in its equity instrument. The cash settled, whereby the entity will settle with cash, but that cash is based on the value of the entity's shares. And the third one, whereby it is the supplier that will decide whether he wants to be settled in cash or in shares. Okay. Now, based on what I've explained so far, there are some terms that are necessary here. One is share-based payment transaction. from what I've explained, you see that that will be a transaction whereby an entity receives goods, then they either decide that the consideration will be in equity instruments or it's going to be in cash that will be based on the entity's share price, right? That's a share-based payment transaction. And of course, before there can be a share-based payment transaction, there will be an agreement. That's what we call share-based payment arrangement. And I've explained equity instrument to you, usually shares or share option, but they just defined it in line with the definition of the conceptual framework here. A contract that evidences a residual interest in the asset of an entity after deducting its liability. So equity instrument granted. So this is usually when the entity has finally issued out the shares, or when if it were to be a share option, when the share option becomes shares and the entity now grants it to the supplier. That's what we mean by granted. So it's just issue, like equity instrument issued. So equity instrument granted, right? Then I also explained share option to you. And the way I've explained it to you is a way to not forget. I told you that is a right that it gives the supplier a right. It's a right the supplier has to buy the shares of the company at a future price at a future date. Okay. Then intrinsic value, I'll leave this one for now. I would intentionally leave this for now because I've not really mentioned anything around it. So when I mention something around it, then it will make more sense to us. But for now, explaining those definitions, I'll probably move it away from here to another aspect of this note. Then measurement date also. So really, the measurement date, I could see this as the date of the agreement. Let's take it like that, right? The date of the agreement, it could be that, and it could also be the date in which the entity issued the shares. The date in which the entity issued the shares. That's the measurement date. Okay, so what I've said so far now, your understanding of it is extremely important to whatever it is I want to say going forward. So, because this is not a physical class, let's do in line with our practice. Let's see if you followed me. So let's look at this just to review what I've said so far. The first quiz here states that, and again, when you want to answer, you don't really have to talk, right? You can just type your answers in the chat section. I will see it. I will see it, and we'll see who has the right answer. So the first question here states that which of the following is not a type of share-based payment transaction? Which of the following is not a share-based payment transaction? Okay, so can you please read it yourself and just type the answer on the chat session? Aramide, okay. C. Okay. Let's see. Yeah, C is the correct answer. Okay, because the first one, transactions where an entity receives goods and either the entity or the supplier has a choice. So this is the third one. This is the third, cash or settled, right? Cash or equity settled. Second one, transaction when an entity receives good and settle the transaction with equity. So this is equity settled. Transaction where an entity receives and we settle cash in 2 weeks. This is like the normal transaction. So this one is not share-based payment. And the transaction where an entity receives good and settle in cash that are paid. So this fourth one is cash settled. Okay, nice one, Aramide. Yeah, Fidelis, yeah, you're correct too. Okay, let's go to quiz 2. The quiz 2 says that transactions where an entity receives goods or services in exchange for the equity instrument of the entity is known as A, cash settled, B, equity settled. C, none of the above. Yeah, that's correct. Aramide is correct. So that's equity settled. So let's go to the third one. The third one states that transaction where an entity receives goods in exchange for cash that are based on the share price of the entity is known as equity settled, cash settled, all of the above. Yeah, that's B, cash settled. Okay, nice one. Then the next one, a contract that gives the holder the right but not the obligation to subscribe to the entity's shares at a fixed or determinable price for a specified period of time is known as equity instruments, option, share-based payment transaction. What's the answer to this one? A, equity instruments. C, share option.
C.
Yeah. Yeah, C is the answer. C is the answer. So a contract that gives the holder the rights, but not the obligation to subscribe to the entity shares at a fixed. Yeah. So C is the answer. Though remember, I told you that when we say equity instrument is shares and share option. Okay. So, but since they give us share option here, that means share option is the answer. So share option gives the holder, the person that has that option, it gives him the right to buy the shares of that company at a future price at a future date, right? So the price and the date is determined. So the answer is C, share option. And finally, says that a transaction in which the entity receives goods and services as consideration for equity instruments of the entity or acquires goods or services by incurring liabilities to the supplier of those goods or services for the amount that are paid based on the price of the entity's shares or other equity instrument of the entity. This one is long. So what's the answer here? C. Yeah, that's correct. The answer is C. That's share-based payments, share-based payment transactions, right? So this one is everything. Is everything. So this one is both equity and cash, right? Which is what we have here. So liturgy is correct. The answer is C. Okay. So I will send you this note so you will see all these quizzes and the solution. Fantastic. So that means you guys followed. Well done. Let's keep that up. Now, let's continue. So now, the second thing we want to learn is recognition of share-based payment transaction. For those of you that were in this class, when we did conceptual framework, you would remember that recognition is the chapter 5 of the conceptual framework. And recognition talks about including an item into the financial statement. So what we want to look at here is that when can you include a share-based payment transaction into the financial statement? Okay, and the answer is straightforward. You include it into the financial statement when the buyer receives the goods or services. Okay, so an entity should recognize goods or services received or acquired in a share payment when it obtains the goods or services. So as soon as the entity receives goods, then you should recognize the share-based payments arrangement. Now, then the question is this: when we say recognize, when we say you are including something in the books, in accounting or in reporting, it always have two sides. It always have a dual effect. That is double entry. Okay. So which two items are these going to affect? Which two items are this transaction going to affect? So firstly is let's start with equity settled. For equity settled, it's obvious the entity is receiving goods or services, right? So if it is services, that means probably you are going to have an account for that services, which is going to be an expense. expense. But if it is goods, or maybe they can even acquire an asset, it could be an asset they have received. So that one, it's not going to affect an expense account, but rather that would affect an asset account. So the first item that will be affected is the fact that the entity has received goods or services. So they will recognize either an expense or an asset. That's the first leg, expense or asset. The second leg, which is for the fact that the entity is going to issue either shares or share option. They are going to issue either share or share options. So I want to push this to the class, right? Just type your answer. So what should the second leg be? If what the entity has issued is shares, if what they have issued is shares, so what do you think should be the account that the company would recognize for that? I've told you the first account is the fact that they are receiving goods. So they will recognize either an expense or an asset. If it's services, it's going to be an expense. It's just like I offer a professional service to a company. That company will debit professional fees they are paying me. It's an expense. Or probably they buy an asset. That would be an asset. So asset or expense. But the other leg that the entity would record. I mean, I need you to put something in perspective here. IFRS 2 only focus on the buyer. Whatever the seller does is not a business of IFRS 2. We are focused on the buyer, the person that is paying with shares. That's the person we are focused on. So my question to you, I want you to participate. What do you think would be the other account the entity would recognize for issue of shares? I need your contribution. Please, 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 please. Turn around, turn around, turn around, turn around. Aramide, dated you. Okay, a lot for equity account, shareholders equity. That's correct. That's correct. But a more correct answer would be share capital and share premium. That's a more correct answer. Share capital or share premium. Nice one, Elofu. So what about if what the entity has decided to issue is share option? Remember, when I say share option, it means that the company is just promising that, okay, probably they want him to do something for a certain number of years. And I said, okay, just hold on for some years. Then maybe after 2 years, then you can become a shareholder. But at least the supplier or whoever has an agreement called the share option, right? He has a contract called the share option. So if what the company has issued is a share option, just an idea, what do you think is the account the company will recognize in their books? I mean, just guess. Aramide, you're not talking again. Fidelis, they said you. What do you think? What do you think? It's just so easy. It should not even take you so long. To recognize accounts is just so straightforward. Just tell me share option account. I mean, nobody will mark you wrong for that. It's just as simple as that. Okay. But for the fact that you're in this class, I would have said, okay, then when we say share option account, like where would that be? Okay, so it's also going to be under equity. However, it will be a reserve under equity. It will be a reserve. So they would recognize a reserve. They will call it option reserve. So they will put it in a reserve pending that period. So when that date comes, they will just transfer it from the reserve and take it to share capital. They will transfer it from the reserve and take it to share capital. So it's going to be an option reserve account, or you can simply call it equity reserve. But it's a reserve that would be the other account that the entity is going to recognize. Okay, so that's recognition for equity settled share-based payments. Before I move forward, is there anybody that is not clear on that? You can just type, I'm not clear. Do you get? Is there anybody that is not clear? Okay, nobody. Okay, good. That means you all understand that when an entity enter into an equity settled share-based payment, the first leg they will recognize in their books is either an expense or an asset. And the second leg is if it is shares they are issuing, they will enter or increase their share capital and share premium. Yeah. But if it is share option they are issuing, that will increase their reserve, specifically an option reserve or equity reserve. You can call it any of those two. But in these notes, what we adopted was equity reserve, just for clarity. Okay, so let's move to cash settled. For cash settled, how are we going to recognize it? Don't forget that for cash settled, what we are ultimately going to do is that we'll pay cash. But not that we are paying cash now. We are going to pay cash in the future. And that cash we're going to pay, the value is based on the shares, on the share price of the company. So yet again, the company is receiving goods in this cash settled also. So we are also still going to recognize an expense or an asset depending on what the entity is receiving or what the buyer is receiving. And the other leg, for the fact that they are still going to pay cash in the future. So what they have is a liability. They are still going to pay cash. They are still going to pay cash in the future. So what they have is a liability. So for cash settled, the other leg of the account they will enter is a liability account. And that's for cash settled. And for the other one, which is the third one, whereby is the supplier that would decide. That one is a bit tough, right? And I don't want to introduce that yet because for the entity now, the entity is now not sure, or the buyer is not sure what the seller will ultimately say that he wants. He doesn't know because it's the seller that will make the decision that, okay, I want you to give me shares or share option, or I want you to give me cash whose value will be based on your share price. So the company is not sure, the buyer is not sure what the seller would want to say, would take. For that reason, it becomes a compound instrument, So of course, they have received good, we are still going to recognize an expense or an asset. But the other leg, there's a way we would have had to separate that instrument into equity and debt. So it's going to recognize both equity and liability. So whatever the guy decides he wants to choose in the future, then he would write one off and recognize the other. But that is definitely going to be a compound instrument, which we are going to get to. Elofu, please go ahead with your question.
Please, I wanted to know if, say for instance, the seller is
Yeah.
requesting maybe for share or share option, and my company doesn't have that to give, or I'm not willing to, under like just normal law, can I refuse and maybe insist on cash? Is it possible to reject what the seller is asking for?
Yes, it is actually possible, right? So, and the reason why I said yes is that nothing is impossible. Nothing is impossible. So if it is equity settled now, if it is equity settled whereby you have agreed that one, nobody can reject anything. You have already committed yourself. If it is cash settled, that one, nobody can reject that. However, if it's the situation whereby the guy is making a choice, he's the one that will make a choice. So you can reject it. So it just depends on negotiation and how you're ready to compensate the guy. Because if you say you don't want to give him what he wants, that means what you now want to decide to give him must be good enough for him to accept your no. So that one is a more practical issue. So, but what the standard said is that is the seller that will have a choice, right? So the standard didn't talk about whether the buyer can reject it or not. That's why I said, yeah, it's possible that they can reject. Well, that's a fantastic question. I love that. But did I answer the question?
Yes, you did. Thank you.
All right. Okay, good. So let's move to the next one. So we are done with recognition. Recognition. Now let's go
Sir,
to,
sorry.
yeah, Aramide, I'm with you.
Sorry, what come again, sir? The account you said when the seller will be the one deciding on what he wants, what account will be created or recognized?
Okay, so the first obvious one is expense or assets. The second one is that the company is going to recognize both equity and liability. So that's a compound instrument. They will recognize both equity and liability. So the challenge is now the split. How do you split it? And that's what this class is meant for. We are going to teach you that. Did I answer your question?
Yes, sir.
Okay, good. All right. So let's move to measurement. Measurement of equity settled share-based payment. Again, chapter 6 of the conceptual framework talks about measurement. And if you remember, that is the amount at which you would, the monetary value at which you attach to what you have recognized in your books, right? So in this case now, I want to start with equity settled. Okay, so I will concentrate on measurement of equity settled now. Then when I'm done with this one, then I will now go to measurement of cash settled. So then I'll go to the measurement of the one where the seller that has a choice of what he wants. So this recognition I looked at here is recognition for everything already, right? So measurement now, I want to focus on equity settled. Okay, remember that the equity settled, what we have recognized for equity settled, we have recognized either expense or asset on one hand, and also we have recognized shares, either shares, if what they have issued is shares, share capital and share premium, or it could be an equity reserve if what the company has issued is a share option. So don't forget that those were what we have recognized in our books. So how do we measure them? How do we measure them? This should not be an issue, right? This should not be an issue. Well, because we can easily say, yes, it should be measured at the transaction price or at costs. Then the challenge is always that what will now be the costs in question? What will now be the cost in question? See, the general principle in IFRS 2 is that when an entity receives goods, right, and they recognize that goods and also an increase in equity, they recognize an increase in equity also, the standard said that you should measure the two, both the expense or asset and also the increase in equity. They should measure those two at the fair value of the goods or services received. Let me emphasize on that. So it's just like, let's say I sold goods to Fidelis now, I'm the seller. I sold some goods to him. You know that if I'm a seller now and I sell goods to Fidelis, I'll probably have given Fidelis an invoice. So Fidelis know how much my goods are worth. So for one reason or the other, Fidelis said that he wants to pay me in his shares or share option. I said, no problem. So just make sure you value it at my invoice. That's what we are saying here. Value it at invoice price. So is that straightforward? When I am a seller, when I'm a supplier. However, the challenge now comes now. If this equity settled share-based payment transaction now, if it's with an employee, if it is with an employee, then it now becomes a challenge because if I employ, let's say I employ Aramide as my staff now, and I'll give Aramide a remuneration package. And part of the remuneration package is that Aramide, you have to work with me for 4 years. If you can stay to the end of that 4 years, you will become a shareholder of my company. Okay, what I've simply given Aramide is a share option. Then the standard said that how do I measure that share option? The standard said here that I should measure it at the fair value of the goods or services received. The challenge is this: how do I now measure the services I'm receiving for Aramide, knowing fully well that that remuneration package I've given Aramide, that share option I've given Aramide is just part of our remuneration package. That's not everything. Of course, he will still be collecting salaries every month. But in addition to that, I said, okay, I'll give you share option, right? So that portion of it, how do you now get the value? So it's not possible. That's why the standard said that where the transaction is with parties other than employees, we can easily know the value of the goods or services. But if it is with an employee, we can't know. For that reason, we would not be able to measure this transaction based on the value of the goods or services received. For that reason, we'll now measure it based on the value or the fair value of the equity instrument granted. So we'll not measure it based on the value of the goods or services received. We'll measure it based on the equity instrument granted. So what we are simply saying here is this. I've just said two things, really. The first one is this: if it's a transaction with an outside supplier, somebody that just came to sell goods to us, right? So if I am the buyer and Aramide is the seller, in my books, I'll simply recognize that transaction at the value of the goods Aramide is offering me. Of course, we can simply see that on the invoice. However, if this transaction is with an employee, it's difficult for us to now know the value of the services. For that reason, we are going to measure this with reference to the fair value of the equity instrument I want to grant to that employee. So that is how this is measured for equity settled. Okay, so that is that. Now, let's look at this question for that. Let me see. Let me cover the solution. Please, let's pay attention to this question. So this question says that a company issued share options on 1st June 2006 to pay for the purchase of inventory. The inventory is eventually sold on 31st December 2008. The value of the inventory on 1st June 2006 was 6 million. And this value was unchanged on the date of sale. The sales proceeds were 8 million. The shares issued have a market value of 6.3 million. How will this transaction be dealt with in the financial statements? Let me make this question easy for you. How do you measure this? At what amount are you going to measure this transaction? So this is just a simple snapshot of what I've been explaining so far. A company issued share options, right, as consideration for buying inventory on these dates, right? So, of course, they said they will eventually sell it in 2008, right? So they said the value of the inventory is 6 million. They sold it for 8 million in 2008. And the shares issued, the share that we issued have a market value of 6.3 million. So what value are we going to measure this transaction on? So, I mean, it's clear here. The two legs here is going to be at 2000, and this 2008 is not relevant here because we are talking about 2006 now. So the two transactions or two accounts is that first is the fact that we are buying inventory. So like there will be a purchases, right? And the other leg is going to be, because this is a share option, the other leg is going to be like an equity reserve, right? So it's a choice between, are we going to measure this at 6 million, or are we going to measure it at 8 million, which is, this is the cost of the goods that we bought. This is how much we sold it eventually. And this is the value of the option or the shares or the share option that I'm issuing out to that person. So which of these values do you think we should use to measure these transactions? You can just simply type your answers. You can just simply type your answers. So which one do you think we should use? 6.3, 6.3, 6.3. I need more answers. Participate now. Okay, let me not say participate now. Some people might be sleeping already. Okay, so that's correct. Multi 6.3. So that's correct. You guys are correct. Like I'm proud of you guys. That means you understand what we are saying. Thank you very much. You are wrong. You're very wrong. Why did you say 6.3? Why did you say 6.3? That means you don't understand what I've been saying. Yeah, you don't. So it's clear here. If what I've explained earlier is that if the transaction is with an outside supplier, we bought good from somebody, I said we're going to measure it at the fair value of the goods received or at the value of the goods received. But if the transaction is with an employee, we are going to measure it at the fair value of the equity instrument granted. So the question you should be asking yourself is that this transaction, is it with an employee or with an outside supplier? This is with an outside supplier now. We bought inventory. We cannot buy inventory from our employees. So we are going to measure this at the fair value of the goods or services, which is going to be 6 million. It can't be 8 million, right? Because inventory is measured at the lower of cost and net realizable value, one. And two is that this sales process is in 2008. We're talking about 2006 now. So the right answer is 6 million, not 6.3 million. Is that clear? I need you to talk. And unmute and talk if it's clear. If it's not clear, let's explain it again. Is it clear or not? Okay. So, yeah, it is clear. And which is what I've explained here. States that the fair value of the goods and services received should be used to value share options unless the fair value cannot be measured reliably. Thus, equity would increase by 6 million and inventory value would be experienced and so. Okay. So that is that. Now, we have learned about fair value. Okay. So this one said that the amount at which you can sell an asset or settle a liability is fair value. So fair value is just like market price. And there's one other one which is grant dates. Grant dates. So grant date is just the date of the agreement. The date of the agreement with the other party. The date we entered into an agreement with the other party. The date we issued the share option, the date we issued the shares. So that's the grant date. So let's note these two terms. Okay. So let's move forward. So this one is talking about how do you determine the fair value of the equity instruments granted? Since we have said that for transactions with employees, we should use the fair value of the equity instrument granted. How do you determine it? The whole story here is just saying that it's just the market price. It's just the market price of the shares. For share option, you are going to learn how that is measured. They will tell you really, but there are some that they use valuation technique, but the valuation, the way the value is determined is really beyond the scope of this exam. Nobody is going to ask you how the value is determined. They will tell you. But generally, when we say fair value, we're talking about the market price of the company's shares, generally. Now, if you are sleeping, you might want to open your eyes now. This is like the most important part of most things we have been talking about now. This will determine how we would account for these things going forward. Okay. So, from here going forward, I would focus on transaction where services are received, especially from employees. So I'm going to focus on employees. Your exam is going to focus on employees. The last question we did that I asked you, you also told me 6.3 million, where the answer was 6 million. That one is transaction with suppliers, with outside suppliers. It's straightforward. It's always straightforward. They will just give you the value of the goods, and that is how you measure it. It's just the cost of the goods, except where the net realizable value of those goods is lower. But usually it's the cost. Whenever is a transaction with a supplier, it's just the cost of the goods. That's how you measure the expense or asset. That's how you measure the shares. And those transactions with those guys is always immediate. It's just one-off. So by the time you pass that transaction, that is all. You recognize expense or assets, and you also recognize shares or equity reserve. That is all with the value of the goods or services received. So your examiner will not ask you that. They have never asked that because it's straightforward, right? The only place they can ask it is in maybe that question 1, when they ask you to prepare consolidated account, they will ask it as part of the additional information. But beyond that, I don't see them asking it as a standalone question. So usually, what they will ask as a standalone question is where the transaction is with employees. So normally, right, when you receive service or somebody offer you service, is either the person satisfy the service immediately or the person satisfy the service over time. So when I say immediately, I mean within a year. So it's like just like auditing service or maybe IT service. It just comes and offer you the service immediately. So when the service is immediately, so usually you will never find a situation where the company will issue a share option. The guy will not even agree. The guy wants to collect his shares immediately because the company has received the good of services immediately. So he should pay the consideration immediately. So he will issue shares. Nobody will accept share option for that situation. So again, at a point in time, he's out of it again because it's straightforward. It's just debits or recognize the expense or assets, recognize the shares, majorly shares, because that's what those guys will accept. However, what you would find in your exam is where services are offered over time, and this is common with employees, because employees is expected to be there for many years. And in fact, the reason why they give them share option is so that they can be there for many years. So for that reason, when an entity receives services over time, you will see that when the entity wants to pay with equity instruments, they will give share option. They will not just give that share option. They will now attach condition. They will attach condition. And those condition is always service condition. Service that you must be with us for so number of years. It's mostly service condition that you must be with us for so number of years. So that will be the condition attached to that share option. So if they tell an employee that, okay, I'm giving you this share option, no, and the only condition for you to convert to shares is that you must be with us for 4 years. So if the employee leaves before that 4 years, automatically that means the employee will not, that share option will never become shares. It will not vest. It's when I say vest, meaning that to become shares for the employee to become entitled to those shares. So it will never vest. if the employee leave. But if the employee stays, then it will vest. Then at that date, the employee can then, okay, I've done the condition you gave me, give me my share. So over time, one of the conditions that will be attached is the service condition. Another condition that will be attached could be performance condition. So performance condition could be that, okay, you must ensure that our sales improve by maybe 50%, or you must ensure that our share price go up by maybe to this amount. So they could attach all sorts of conditions to it. The only one we are going to consider here that affects whatever it is we are doing here today is where the condition attached is the number of years. In fact, it's always mostly going to be number of years in most cases. And that is where our focus is going to be. So the challenge is this. If I give an employee a share option, and I say that before this share option can vest, you have to work with me for 3 years. If you work with me for 3 years, I'll give you a share option. So let's just assume that the share option is worth, let me just assume is worth 1 million. Let's assume the share option is worth 1 million, right? And so after the 3rd year, I will give the guy shares worth 1 million. Let's just put it like that. So how do you think this should be recognized and measured in the books? Should it be recognized now at the grant dates and the intervening period, or should it be recognized at the vesting dates? Or when I say vesting dates, when the share option becomes shares, when the employee can then convert it to shares. So should it be at the grant dates or at the vesting dates? When should this be recognized? Should it be recognized now, or should it be recognized at the vesting dates? If I give them share option that would vest in the future. So what do you think? Okay, Aramide said it should be recognized at the vesting date. Okay, so let's go straight to the point. So now, it should not be recognized at the vesting date or when the employee converts it to shares. No, in fact, that was what was done before this standard. Companies were not recognizing anything at all. They will wait until the share option vests. They will wait. When I say vest, this is spelling of that vest. They will wait until it vests before they recognize it in the books. When the employee wants to now collect shares, that was wrong. In fact, the way it should be done, remember, the way it should be done is on the basis of how we recognize share-based payment. I told you that share-based payment is recognized when the goods or services are received. When the goods or services are received. So since the employee is going to offer the service over time, so that means we are going to recognize that share option too over time. Just that I told you that the value of the share option is 1 million. So we just find a way of spreading that 1 million over 3 years. So we'll be recognizing it small. So that's what we want to learn. We'll be recognizing it bit by bit. So it's going to be recognized over time too, because the service is rendered or we receive the service over time. So we're going to recognize the share option also over time. And that's the core of everything I'm going to be explaining going forward. Okay. So now, the key thing is this, right? The key thing is this. I gave you a simple example that I gave my employee share option worth 1 million, that after 3 years, I will give him shares worth 1 million. But I now told you that for the fact that the employee is offering a service over time, we need to recognize that 1 million over the 3 years. Don't wait till the vesting date. Recognize it over. In fact, that is in compliance with accrual concept that we learned under the conceptual framework, because we're already enjoying the service from the employee. So we need to recognize an expense for that. Okay, but the challenge is this, right? I told you that we need to find a way to recognize that 1 million over the 3 years. So how do we do that? This is what the standard said. So the standard said that at the end of the first year, right? So he said the entity will recognize an amount for the goods or services received during the vesting period based on the best available estimates of the number of equity instruments expected to vest after the vesting period. So what this means is that we need to make an estimate of how many employees will actually be there at the vesting date. Do you know that it's possible that you might give 4 employees, share option, and some of them might just say, okay, we don't want. Some of them might leave after a year. Some of them might leave after 2 years. So, because we don't know who will leave and who will not leave, right? So at the end of each year now, the standard allows us to make an estimate of, okay, how many people are we actually going to give this thing to? So that it is those ones alone who will get the value and spread it. Maybe that 1 million example I gave you is for 5 employees. Maybe at the end of the first year, one person now left. On that basis, I now say, okay, let me estimate that 20% of them will leave before the end of that vesting date. What is key here is this. At the end of the first year, I need to estimate how many people would actually enjoy this, or how many people, or let me put it as, how many employees will be there to convert those share options to shares at the end of the 3rd year or at the vesting date. I need to make that estimate. I can't know for sure, but that is what I have to recognize in my books today. If I'm recognizing any other thing, I might be overstating my expense. So I need to have an idea of whom am I giving this thing to, how many of them, and the only way is an estimate. So don't stress yourself too much. The examiner would give you this estimate in the exam. They will always give you, okay? But you know now, they won't make it straightforward, which is why I'm emphasizing the fact that you need to understand that what we recognize in the first year is an estimate of the number of employees that will be there at the vesting date, because those are the people who would eventually give it to. That is the value of the share option, and that is what we have to spread over the period. So, and like I've explained, the reason why we are making estimates is that we cannot ascertain with precision in the first year how many employees will remain at the vesting date. So there's no way for us to ascertain that. And in subsequent years again, maybe in year 2, now, if you now have new information, then we can revise our estimate too, right? Maybe the estimate you have made in the first year was that out of these 5, only 3 will remain. Because of what happened, maybe one person left. We just assume maybe another person will leave the next year too. It's just an estimate. But what is important is the estimate we are making is we want to have an idea is how many people will actually get this share option. How many people will actually convert this share option to shares, or to put it more technically, how many employees will vest in the second year. Let's assume nobody left. We now say, for this reason, let's revise our estimates. That 3 we did in the first year might not work. Let's estimate that 4 4 is the number of people that would vest. So that means our valuation will change again to 4. All of these I'm saying, the examiner will give you, but they will give you a lot of things there. Just testing or ensuring that you understand that what you need is the estimate of the number of employees that will vest. They will give you a lot of things, but you need to focus your eyes on how many employees will vest. Okay? To put it in other ways is at each year end, you need to just estimate, okay, what is the total people that will leave over the period? So in year 1, you estimate, they will give you an estimate of the total people that will leave over the period. So from there now, you now know, okay, this is the estimate of the people that will remain at the end of at the vesting date. When I say vesting date, I mean when the share option will be converted to shares. In the second year, the same thing. The only time where you are not making estimates is the vesting date itself. That one does not require estimates, because at the vesting date, we already know the number of the employees that have departed. We know the number of employees that remain. And on that basis, we can value our share option. And on that basis, we can know how many share options we are giving out. But before the vesting dates, we have to keep making estimates. So the key terms I've been mentioning so far here, one is I've been mentioning vest. When I say vest, it means when the employee now convert the share options to shares, then it has vests. And of course, it's the employee that meets the vesting condition that can vest. And the vesting condition, I've told you, it could be service condition, it could be performance condition. And I've told you that what is relevant here is service condition, that the employee must be there over a certain number of years. And of course, that number of years is specifically the vesting period. Number of years is the vesting period. Okay, if you understand what I've said, you understand equity settled. That is everything. So what is left for us now is just to solve questions. As far as equity settled is concerned, I've done all the major explanation. I'll just be adding little details. But the major thing, the core idea here is how to do that measurement, which is that at each year end, because it's at the end of the year, the first thing I mentioned is that you don't recognize the share option at the vesting date. You recognize it over the vesting period, since the employee is rendering service over time. Being that the case, you measure it at the best available estimate of the number of employees that will vest. That is very important. Estimate of number of employees that will vest. Okay, so I hope you understand it. So I think there's only one question here, right? It says that when a service is satisfied over time, in the first year, the equity instrument granted and goods or services received will be measured at fair value of the goods or services, fair value of the equity instruments, best estimates of equity instrument expected to vest at the end of the first year. Which is the answer? You can just type your answer between these three. Which is the answer? C, that's correct. The answer is C. Okay. Nice one, Aramide and Fidelis. Now, let's go to the question of the day. So, please, for those that are still in class, I need you to participate in this question. So the question states that on 1st January 2001, an entity grants 100 share option to each of 400 employees. Each grant is conditional upon the employee working for the entity until 31st December 2003. Now say that the fair value of each share option is 20 naira. The fair value of each share option is 20 naira. That is at this date. So before I go to this second paragraph, now this first paragraph, this 1st January was the date when they granted 100 shares. That means this 1st January is the grant date. Is the grant date. And they are giving each of their employees 100 share option, and they have 400 employees. And there is a condition, and the condition is that the employee must work for 3 years. That is the condition. So that means the vesting period is 3 years. Abi, let's count it to 2001, 2002, 2003. Yes, that's 3 years because the employee must work until 2003. If for whatever reason the employee leaves before this date, you will not get anything. You will not get. So he now said the fair value of each share option is 20 naira. This is another very important value here, which is we call it the fair value of the option. And this fair value they are giving us on 1st of January 2001. So this is the fair value of the share option at the grant date. At the grant date. So this is usually what we use to value those share options. This 20 naira at the grant date. Don't use any other fair value for equity settled. It is this fair value they have determined at the grant date. That's the most important. Usually, well, this question did not do like that. For you, it's straightforward. The examiner will now give you the fair value of the shares. Shares is different from share option. No. Shares is the share price of the company. Don't use that one. No. Since what we want to value is share option, so we are going to use share option. The entity can give you the share price, or they can even give you the fair value of the share option at the end. Don't use that one. No. The relevant one is the fair value of the share option at the grant date. At the date they will have agreed it right from day one. And this is how they're going to measure. It's 20 naira they will use to measure it over the period. Since this share option we said is going to be measured over the period, so is this 20 naira we're going to use over the period. Now let's now go to the estimates they gave us. The examiner said that he said during 2001, 20 employees leave. And the entity estimates that 20% of the employees will leave during the 3-year period. Okay. In the next paragraph, they said during 2002, a further 25 employees leave. And the entity now estimates that 25% of its employees will leave during the 3-year period. And the third paragraph, during 2003, a further 10 employees leave required. We're now asked to calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended 31st December 2003. Calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years. Okay. So that means we need to start from 2000. Before I go to the solution, I show you the solution. I want us to discuss it first, right? So in 2001 now, they have already given us the estimate here in 2001. And I have emphasized deeply that what is important is for you to establish the number of employees that will vest in each year. So they can present it in different ways for you. What is important is that there's no way we would know with precision or with certainty the number of employees that will vest, because that's in the future. We can't know the future. So it's only an estimate we can make, or what is happening today, right? So now looking at the way this guy has coined it, they have coined it in a way that they are telling me the number of people that will leave, estimate of number of people that will leave over the 3 years, and people that left in the first year. So since if I can know people that will leave over the 3 years, then obviously I can easily determine people that will not leave, right? Which is what I need, is the people that will not leave, because that is what I need to put in my books. Those are the people that will get it. So I don't want to put something in my books for people that would not be around. So now, from this 2001 now, they said 20 employees leave. Okay, yeah. So they can say that authoritatively because this is the end of 2001. We can know people that have actually left in year one. So 20 left. They now said that, and the entity estimates that 20% of the employees will leave during the 3-year period. During the 3-year period, don't forget that the vesting period is 3 years. So this guy is saying that, okay, on the basis of the 20 people that have left, right? That's how I'm explaining. That's what it means. So I'm estimating that 20% of the employees will leave over the 3 years. Year one inclusive, over the 3 years, 20%. Okay, so let me please participate here because this one is key. This is it. So tell me, what's the estimate? What I need from you is this, right? What I need from you is this. I need you to tell me the number of employees that will vest at the vesting date in year one. Okay, I can see 2 people said 320. I can see 3 people said 320. Are there any other opinions? Okay, yeah, 320 is actually correct. 320 is actually correct. Yes, Zainab also said 320. So, exactly, 20% times 320. Yeah, type it. 20% of 120. What would that give you? 80. So 80 is your answer, Motaya. 80 is just the people, is the estimate of the people that will live over the 3 years now. The estimate that 20% of the people will leave. What I want is how many people will not leave. That's what we need. And you said it's 320. So Motaya, are you clear? Exactly, yes. Yes. Okay, good. So, like, how many people have mentioned? Like 4 people, and you guys were correct. Fantastic. So 320. And the year is clear. What we want at each year is how many people will not leave. And there's no way we can know that. It's only an estimate. The question will tell you the estimate. And the question already told us that 20 leave. Of course, we will know that at the end of the year. So what is important is that they now estimated that 20% will leave over the 3 years. So that means we even consider these 20 that actually left because they have made estimate of over the 3 years, year one inclusive. So 320. So you guys are perfectly correct. So because you were correct, let me show you the solution in year one. So in year one now, which is 2001, okay. So I will have 40,000. This is how I got that 40,000. How many employees do I have? I have 400 employees. Multiply by 100 share option. 100 share option. So the percent estimate of people that will not leave is 80%. 80% will not leave. 80% will not leave. Then I told you that whatever you now get is the number of equity instruments that will vest. Then the valuation you use, I told you, don't ever forget this. You use the fair value of the share option at the grant date. They will always tell you the fair value of the share option is this, which is the fair value on 1st January 2001. So you multiply it by 20. So if you press your calculator, you will get certain amounts. That amount you get is the value of the share option, the entire value of the share option for the entire 3 years. For the entire 3 years. So since there are 3 years and this is year 1 alone, so you need to prorate it and multiply by 1/3. If you multiply that by 1/3, you will get 213,333 on one leg. So when I said cumulative expense at year end, what I'm referring to here is the equity reserve, because reserve is the other leg, the one that will be in equity. Is always cumulative. You carry whatever is in reserve forward. So in year 1 now, yeah, one leg goes to reserve, the other leg goes to expenses. But what the question asks us is to calculate the remuneration expense, right? So this is what the examiner is actually interested in, the expense. So the other leg goes to the expense for the year. So this year now, and the specific expense is staff costs, because we are granting this to our employees. So it's going to be a staff cost. So to get this amount is not hard. What is important is to ensure that employees times 100, ensure that you are able to know that it's 80% that will not leave, right? Okay, so that's correct. Now let's move to the second year. Please, let's stay muted, except if you have a question, which you're expected to raise up your hand, but any conversation, let's throw it in the chat section. Now let's go to the second year. So in year 2 again, they said that a further 25 employees leave. And the entity now estimates that 25% of its employees will leave during the 3-year period. During the 3-year period. So again, of course, this is year 2. We will know the number of people that left in year 2. So that one is a no-brainer, right? The brainer is that now we need to now estimate, okay, how many people will not leave? And there's no way we can know that with precision. It's only an estimate, because this is still year 2. There's no way I can know the number of people that will not leave in year 3. I can't. It's not possible. So the question made life easy for you. They gave you an estimate that 25% of its employee will leave during the 3 years. So we're talking about over the period. So this guy has already given me estimate of the number of people that will leave. I can easily know the people that will not leave. From what? So my second question to you again is that how many employees will not leave? What's the estimate of number of employees that will not leave at the vesting dates? I want to hear from you before I go to the solution. Data you said 300. Okay. Let's hear from others. Zainab said 300. Okay. Yeah. Amotayo, 300. Fantastic. Amotayo broke it down. Okay, good. So, yeah, you understand the idea. So you just did 25% times 400. That will tell us the number of people that will leave Then 400 minus the people that will leave. So that leaves us 300. Okay, fantastic. You are correct. Everybody is correct. All of you are correct. So let's go to the solution. So in year 2 now, again, you know how I got this 400, which is the 400 employees times the 100 option we are giving to each of them, multiply by 75%, which is the estimate of people that will not leave. That will not leave, right? So then I multiply this by 20, which is the fair value of the equity instrument at the grant date. So don't go and say this is year 2. If the examiner wants to be wicked, the examiner will give you another fair value of share option in year 2. If you go and use it, you're wrong. Go. Don't ever use that. Always use the fair value of the share option at the grant date to measure it, right? Which is 20. Okay. And another way you can calculate this thing is to still give you the same thing. So that 300 you computed in year 2 now, if you just do that 300 multiplied by 100, it will give you the same thing. It's still the same thing. So however you want to do it, or that year 1 that we got that 320 that will not leave. If you just multiply by 320 times 100, 320 employees times 100, it's still the same thing as this. So what this guy did is just get everything, then he now did people that will not leave. Get everything, now did people that will not leave. So that's the approach we're using here, but you can use another approach. Now, this is year 2 now. So you now multiply this by cumulative for year 1 and year 2. You do 2/3. So that will give me 400,000 cumulative for year 1 and year 2. So as far as I'm concerned as a company now, the worth of this equity share option that my employees have worked for is 400 as at today, year 1 and year 2 inclusive. Of course, that will go and sit down in the equity reserve. But that's not what the examiner is concerned with in this question. What he is concerned with is the staff cost or the remuneration expense. So what goes to your expense? Please listen to this. What goes to your expense is the difference between the cumulative in year 2 minus the cumulative in year 1. If you do this minus the cumulative in year 1, it will give you the one that relates to year 2 alone. And that's what goes to your expense for that year alone. So that will give you 186,667 for that year alone. Okay. So finally, year 3. In year 3 now, they said during 2003, a further 10 employees leave. So year 3 is the easiest because year 3 is the vesting date. Year 3 is the vesting date. So at this date now, we will have known the people that have left. In fact, we would know actually the people that did not leave. So, and the way to do it here is that now, in year 1, we know that 20 people left. In year 2, we know that 25 people left. In year 3, we know that 10 people left. So that means in total, how many people left? 45, 55. 55 people left out of 400 people. So remaining 345 people. Multiply that by 100. It gives me what this guy has here. 34,500. 34,500. Multiply that by the fair value of the share options at the grant date. It's always that for equity settled. The fair value of the share option at the grant date. Now, this is year 3 now. We can do multiply by 3/3, but that's still 1, so it's not necessary. So when you do this now, you get 690, which is how much we now have to settle our staff with. 690. But what goes to your expense for the year is the cumulative at the end of year 3 minus cumulative at the end of the previous year, which is year 2. So 690 minus 400, that gives me 290. And it's 290 that will go to my P&L as staff cost or expense. And that's that for this question. And that is that for this question. Yeah, you guys really showed some serious understanding. I'm highly impressed with your performance, right? So do we have any question from anybody? Do we have any question from anybody? Okay, so we are all clear. Now let's go to this second question. This second question states that on 1st January 2003, an entity grants 250 share options to each of its 200 employees. They grant 250 share options to each of its 200 employees. The only condition attached to the grant is that the employees should continue to work for the entity until 31st December 2006, 5 years, 5 employees leave during the year. Okay. And I've said the market price of each option was 12 naira at 1st January 2003 and 15 naira at 31st December 2003. And I'll say you should show how this transaction will be reflected in the financial statement for the year ended 31st December 2003. So I need you to look at this question again. I'll give you like few seconds. I need you to tell me, because this question asks for 2003 alone, at the end of 2003. So I need you to tell me, just the same way we have been doing it, tell me how many employees will not leave. I mean, when I say will not leave, I mean at the vesting dates. Okay, that's what we need in each year. How many employees will not leave? And the only way we can know that is an estimate, because there's no way we can know for sure how many employees will not leave, because we're talking about future. So we would estimate how many employees will not leave. So usually you need to get, okay, how many people, estimate of people that will leave. Then from there, we'll get the number of people that will not leave. So let's type it. I'll wait for your response. Okay, fantastic, Omotayo. Fantastic. Fantastic. Elofu. Okay, good. So you get the idea. So from what I can see now, you are saying 20 will leave. So that means at the end of year 1 now, we are saying that 20, how many employees do we have? 180. So that means we are saying 180. We are saying 180 employees will not leave. That's what we are saying. 180 employees will not leave. If that's what you're saying, then that's perfectly correct. Because this question is a bit tricky. The examiner didn't give us estimates. We'll have to make the estimate ourselves. So since 5 employees leave in year 1, so we can estimate that 555 will leave over the remaining 3 years, making a total of 20. So if 20 leaves, that means out of 200 employees, that means 180 will remain. So if 180 employee will remain, multiply that by 250 share option, okay, then you are going to value it using the fair value of the share option at the grant date. So this question is tricky now. He gave us the fair value of the option at the grant date. He also gave us the fair value of the option at the year end. So don't say because we are doing this at the year end now, you now go and use 15 naira. That will be very wrong. That will be very wrong. You always use, for equity settled, you always use the fair value of the share option at the grant date, which is 12 naira. So ultimately, we are looking at this 250 times 180, which gives 45,000 option. Okay, you multiply by 12 naira, which is this 12 naira. Since this is year one alone and investing period is 4 years, so we need to multiply by 1/4. So whatever you get, first leg will go to P&L as staff costs. The other leg, you use it to increase your equity as equity reserve. And that's that. And that's that for that. Any question here? No question. So let's solve our last question for today. Then after this one, we can go and sleep. This one says that J&B granted 200 option on its 1 era ordinary shares to each of its 800 employees on 1st January 2001. Each grant is conditional upon the employees being employed by J&B until 31st December 2003. So in this first paragraph now, they already gave me a lot of things that I need. One, I know that they are giving each of them 200 options. They have 800 employees. And I can see that the grant date is 1st of January 2001. And I can see that the vesting condition is that they must work till 31st December 2003. And I can see that the vesting period, 1, 2, 3, 1, 2, 3. So it's 3 years. I can see that the vesting period is 3 years. So that 3 years is very important because that is what you ultimately use to prorate. Okay, so that's the first paragraph. Now, the second paragraph, they now say J&B estimated at 1st January 2001. Okay, so the guy is making an estimate at the beginning of the year that the fair value of each option was 4 naira. Okay, I mean, I need this one because this is the fair value of the share option at this date, which is the grant date. Before adjustment for possibility of forfeiture, well, whether adjustment or no adjustment, they have given me my 4 naira that I need. So it doesn't matter. This does not matter. Second one, this estimate is still at 1st January 2001. Approximately 50 employees would leave during 2001, 40 during 2002, and 30 during 2003. Remember, this is estimate at the beginning of the year. Thereby forfeiting their right to receive the option. The departures were expected to be evenly spread within each year. I can tell you authoritatively that you don't need anything here in this note 2. And the only reason we don't need it is that the estimate was made at the beginning of the year. The standard says that at the end of the year is when you make each estimate for each year. So, but this guy made an estimate for the entire period at the beginning of the year. That cannot work. That cannot work. So we're not going to use anything here. Going forward, in the next paragraph, they said the exercise price of the option was 1 naira 50 kobo. Okay. So now this is a new thing you have not seen before, exercise price. So what I've not told you is this: at the vesting dates, when these share options vest, the employees actually pay certain money. They pay. Just that what they pay is going to be very small, right? In this case now, what they will pay to convert those share options to shares, they call it exercise price. And it's 1 naira 50 kobo. And the market value of J&B shares on this day was 3 naira. You will see that what they are telling them is this: that okay, and all these things they are telling them at 1st January 2001. They're simply telling them that, okay, if you wait and meet the condition, you can buy our shares for 1 naira 50 kobo. Look at, even today, our share price is 3 naira. So employees will be excited because they are looking at it that a share that is worth 3 naira today these guys are saying that in 3 years, we can buy it for 150 kobo, knowing fully well that the share price might even go up again. So it might even reach 9 naira. Whatever the share price is in the future, they are buying it for 150 kobo. So it's extremely attractive. This option is attractive to whoever, in this case, employees now, is going to be extremely attractive to them. So we are still going to talk more on this, but that will be in the next class. But at least it's what it is for this question. The exercise price, 150 kobo. The share price of the company as at 1st January 2001 is 350 kobo. Another confusion is that when you are valuing this option, don't ever use market value of the share. So don't use that. So what we are talking about here is option. So it's going to be the market value of the share option, which is this 4 naira. Don't mistakenly go and use this one. Oh. Now, the last paragraph, there's now said in the event. So in each year, in the event, they said that only 40 employees left during 2001, and the estimate of the total departure was revised down to 95 at the end of 2001. Okay, so this is the estimate at the end of 2001 of the total departures. Then I said also 20 now left during 2002, and the estimate of total departure was revised to 70 at the end of 2002, and none during 2003, spread evenly during the year. So saying that you should just assume that the same amount left. So I don't even know why they are saying spread evenly during. So we really don't need that in this question. Required. The directors of J&B have asked you to illustrate how the scheme is accounted for under IFRS 2. Show the double entry for the charge to POL for employee service over the 3 years, and for the share issue, assuming all employees entitled to the benefits from the scheme exercise the rights, and the shares were issued on 31st December 2003. Okay, so it's straightforward. Let's go. So we are looking at 3 years now, 2001, December, 2002, December, 2003, December. So I've told you, this estimate they made at the beginning of the year will not stand. The fact that it's made at the beginning, so we won't work with this at all. What is important is this one, the estimate they made at the end of each year. That is what is relevant to us, okay? So they now said, from here now, so please, let's wake up. So they said only 40 employees left during 2001, and the estimate of total departure was revised down to 95 at December 2001. So again, how many employees will not leave at the end of 2003? Because that's what we need. How many employees? So I need you to type your solution, your answer. At the end of 2001, what's the estimate of the number of employees that will not leave? Of course, that will remain at the vesting date. Okay, Omotayo said 705, and that is correct. Okay, that is correct. That means you really understand this thing very well. So that is correct. So, and it's clear here, they already made an estimate. Yeah, so I know by grade. So they already made an estimate of the total departure. So it's very clear. So they already told us that as at the end of 2001, 95 will leave over the period. So that means the people that will not leave is 705, which is 800 minus 95. So that's perfectly correct. So if you go to the solution now, the first leg go to P&L, the second leg go to equity reserve. And this is how I calculated it. Just like Omotayo has mentioned, 800 minus 95. That gives us 705. So this is the estimate of people that will not leave. So each of them will get 200 options. Each of them will get 200 options. multiply by the fair value of the option at the grant date, which is this 4 naira here. Okay. So since this is year one alone, so I need to multiply by 1/3. Okay. If you press your calculator, that gives you 188,000. And the reason I'm doing debit credits is because the examiner said show the double entry. When the examiner says show the double entry, or they ask you show the journal entry, you have to actually show the journal entry or the double entry. You have to do that. So they sparsely do that, but when they do it, you have to do what they require. So the first leg goes to staff costs. The second leg goes to equity reserve. Of course, when you're doing journal or double entry, debit and credit must be equal. They must be equal. Okay, that's that. So in year two now, you said 20 during 2002, and the entity estimate total departure was revised to 70 at 31st December 2002. Okay, so at 31st December 2002, what's the estimate of the people that will not leave? Your contributions, please. What's the estimate of people that will not leave? Well, that's what I need. Okay, so Datejo have stopped contributing. Elofo have stopped contributing. Fidelis have stopped contributing. I don't know why. Okay, yeah, 7:30, Elofo 7:30. Okay, yeah, that is correct. Omotayo 7:30. Yeah, I like your approach, Omotayo. You will always break it down. Fantastic. So 730, that's correct, everybody. So, I mean, it's clear here. They already told us the estimate of total departure over the 3 years, okay? So, which is 70. So, 800 minus 70 gives us 730. So, if we look at the workings, debit P&L, credit equity reserve, that's always the case. So, let's go to workings 1. That was where I broke it down. And this is workings 1. Yeah, workings 1. So what goes to P&L? This one, 800 minus 70, like you have all said, multiply by the option for each of them, multiply by 4 naira, which is the fair value of the option at the grant date, get the cumulative for year 1 and year 2, which is 2/3. That gives us 389,303. However, I told you that what goes to P&L is for the year. Okay, that was why I have this equity brought forward, which was the equity reserve that we recognize in year 1. This one here. This 188,000 in equity reserve in year 1. Equity reserve will be carried forward, is a reserve. So I brought it forward, 188,000. So the balance here, this is like the balancing figure, is 200 now. So I calculated this 389 using this approach because I used 2/3. This is cumulative for year 1 and year 2. So this is what I recognize in year 2. So cumulative as at today minus cumulative from year 1 will give me what I will charge to P&L in year 2 alone. So if you go and check year 2, I debited P&L, I credited equity reserve with that 201. So since they asked me for journal, that is why I'm ensuring that debit and credit are equal. So automatically, when I'm crediting my equity reserve with 201, don't forget, 188 was in my equity reserve before. By the time I credit it with additional 201, it will increase to this 389 cumulative, right? So, but since they said debit credits, what is in debit? That's why I'm doing this. It's different from what I did in question 1. They didn't ask me for journal. So this is just like a schedule. So I could easily put the cumulative here, right? So I won't have to go through so much stress. Since I know that what goes to equity is cumulative. So I was just only putting the differences in expense. But why the year is different is that they ask for double entry. When you're doing double entry, debit, credit must be the same. So which is why I went to break down the cumulative. Then I got the movement that will go to debit and a credit. Now, in year 3, which is the third year, they said that none during 2003. And don't forget, this year 3 is the vesting date, where we will now know how many people that have left over the 3 years. I know that 40 actually left in year 1. I know that 20 actually left in year 2. And I know that nobody left in year 3. So the actual departure over the 3 years is 60. And I have 800 employees. So 800 employees minus 60, that gives me 740 that did not leave. So in year 3 now, let me show you my workings for year 3, and this is a calculation. So 800 minus 40 that left in year 1 minus 20 that left in year 2. That gives me 740 that did not leave. Multiply by the 200 option per each employee. Multiply by the fair value of the share option and the grant dates times 3/3. This is year 3 now. So that brings me to 592,000. 592,000. So from the previous period, the balance, the cumulative equity from year 2 is 389. So I brought that forward so that I can get the movement that relates to this current year, 202,667. And that was what I transferred to the debit of staff cost and also to my equity reserve here. 202,667 debit, 202,667 in my equity reserve. So that should have been all. But if you look at this question says that show the double entry to P&L for employees serving over 3 years, right? And also they said, and for the share issue, assuming all employees are entitled to benefit from the scheme exercise their rights, and the shares were issued on year 3. Okay. So this one now, they want you to show that, okay, at the vesting dates, because it's going to vest in year 3, then that share option is going to be converted to shares. It's going to be converted to shares, right? So how do we do that? So now, and that's where this issue of shares comes in. First is that the staff are going to pay for it, which is the exercise price. They will pay a very small amount. Relative or when compared to the share price of the company, is small. So it's still favorable to the staff. They are paying 150 kobo. So firstly, we're going to collect money. That's why I'm debiting cash or bank. The employee will pay us, though the money is small. So the number of employees that actually vest is 740. Don't forget, we computed that from here. 740. So 740, we are giving each of them 200 option times 200. Now they are going to buy it for 150 kobo, equivalent to what I will collect from them. So I'm collecting 222,000 from them. That's the first thing. The second thing is that the balance in our equity reserve needs to be cancelled out. When you cancel it out, you are not going to transfer it to your share capital. Let's cancel it out first. To cancel out the equity reserve, if you look at the equity reserve, it has been credit, credit, credit. When you want to cancel it out, you debit it. That cancels it out. And don't forget, the balance in the equity reserve was 592,000. And that is why we are canceling it out with a debit with the same amount, so that there is nothing there anymore. So it's canceled out. Then we now recognize the difference in share capital. So we credit share capital. We credit our share capital with the number of employees that remain, that did not leave, multiply by 200, multiply by 1 error. Why 1 error is coming in is that I expect that all of you should know this. If you don't know this before, know this, that whatever will go to your share capital account must be at the nominal value of the shares of the company. And that was why they gave us this 1 naira here. 1 naira ordinary shares, telling you that the nominal value is 1 naira. So what goes to share capital account is always at 1 naira. So any excess. So ordinarily, don't make the mistake to transfer this 592, go and put it in share capital. That will be very wrong, because share capital doesn't accommodate anything beyond nominal value. So you get the total number of options, 740 times 200, multiplied by the nominal value. That gives me 148,000. And that's what goes to your share capital account. Now, share premium account is anything above the nominal value. Just go and dump it in the share capital account. So since I've debited 222 and 592, if you add these on your calculator, you'll be getting like 814. Now, I've credited 148. If you deduct this 148 from that 814, you have a balance of 666. Take it to share premium account so that your account will balance. So it's a balancing figure. In this case, anyways, in this case. So you take it to 666,000 to your share capital account. And this is how issue of share works in equity settled. This is how it's always going to be. If you know this, you know all. You know this, you know all. Because this is the scenario you are going to have in any exam question, as far as equity settled is concerned. Okay, so for today, I'm going to stop here. Next week, I'll continue. I'll start with modification and cancellation. Then on that note, we'll end equity settled. And next week also, we are going to move into cash settled. And also, finally, we are going to move into deferred tax implication of share-based payments. So next week, we're going to be finishing up with IFRS 2. So the class is over for today. So do we have any question? Do we have any question?